All right, I think we'll go ahead and get started. So good afternoon. Thanks for joining us here today for this retirement planning webinar. We have some great information for you today on this complex topic, and so we're really grateful that you've joined us to walk through this for the next 30 minutes here. So my name is Kendall Beamer. I am an advisor here at Link Wealth Strategies. We primarily do retirement planning and investment management for folks. And we work hand in hand with tax professionals in the area to make tax smart investment and planning decisions. And we really enjoy what we do. So this is the second webinar of our 2023 webinar series. We will be hosting these informational webinars on different topics at noon on the first Wednesday of every month this year. So you can block that on your calendar if you're interested in joining us for more of these. And we will go ahead and show you the different topics at the end here of what we're going to be walking through later this year. So with that, I'm going to hand it over to Kyle Johnson, Senior Wealth Advisor here at Link, to tell you more about retirement planning.
Excellent. Hey, thank you, Kendall. I really appreciate it. And I want to thank you guys for joining us today. Like Kendall mentioned, this is a complex topic that I know is forefront on a lot of people's minds. And it's what we specialize in. It's what we've been doing for over 13 years now. I know we've got a lot of folks on the webinar today that we currently work with. I may just touch base briefly on the name change, that we have updated our name to Link Wealth Strategies, primarily to be a backdrop to what we've done for 13 years now, linking people to what's possible in their own personal situation. And that directly ties to planning for retirement. We're going to talk through 5 basic building blocks of a retirement plan today with you. Before I get into the material today, I want to just address any questions that you may have. The Q&A window at the bottom of your webpage, you will be able to submit a question, and Kendall will share those with me at the end of the webinar and at the end of the material. If you have a more substantial question that we might not be able to address, but maybe need to take it offline, you can certainly email us at letstalk@linkwealthstrategies.com that you see right there. Or if you'd like to meet personally, Creighton Beamer, who is actually in the background right now watching us, is available at our office line that you can see right there, the 785 number noted. So why is this topic so important? Well, a recent Kiplinger article that I read noted that only 25% of retirees have a written financial plan for their retirement years. In fact, a lot of times when we visit with new clients, what we notice is that they might come in with an investment portfolio, and to that point, they have thought that is their investment strategy for retirement. But it's our experience that without a written plan that you review regularly, your likelihood of success can dramatically decrease. In fact, without a plan, a retirement you hope will be satisfying can be more stressful than your working years. Our retirees from only 5 years ago have faced a slew of items in our country, specifically Afghanistan war, sharp market drops, a pandemic, threats of a recession, 8% inflation. All of these things can make you crazy, and they can really stir anxiety in the life of somebody who turns the corner from accumulation during their career to decumulation in retirement. The retirement plan helps you to focus on your specific situation and not the noise of what's going on in our country or in our economy at a given time. And that's the value of the plan, to lower stress and allow you to focus on those things that you desire during this next season of your life. So today we're going to talk about 5 basic building blocks for retirement. None of these items are going to be new to you, but we might look at them in a unique way that you may not have looked at them before. Specifically, budgeting, assets and liabilities, or your net worth, savings rate or cash flow, income plan, and your risk tolerance for your investments, and the culmination of it all for this next season, retirement season of your life. What are your goals, and how do those items all connect together to help you to accomplish what your financial goals and otherwise may be during retirement. So building block number one, budget. It's not the most romantic word, I realize, not the most exciting for a lot of folks that might be on this call. However, just like a football game cannot take place without a boundary, without an out of bounds, so a spending plan in retirement is impossible without boundaries. What we encourage a lot of our clients to do is to consider taking 2 or 3 months worth of a budget to evaluate what your patterns are. I'll share with you a budgeting document that we hand out to folks quite often, and share with you an application we use as well. These guardrails, once you've determined them, do serve just as that, as guardrails for your spending in retirement. They may fluctuate from time to time and need to be reevaluated based on your financial circumstances, but they will give you peace of mind that you're on track to not outlive your money. Right here, you'll see the first page of our budgeting document here at Link. Specifically, some of the items on here that you're very familiar with: your mortgage, your property tax, electricity, gas, water, sewer, home telephone, which not many of us have that anymore, but your cell phone, medical on the right side of the page, life insurance, long-term care insurance. It's a fairly exhaustive list that we put in front of folks, and not all the time are all of these pieces filled out, but it does give you an option, a tool to use to begin to track your spending over those few months that we recommend. The second page of that document has a little bit of the discretionary items that we do encourage people to consider. We don't think that a budget should merely be your basic necessities. We do think margin needs to be built into it for those things that you enjoy: entertainment, dining out, hobbies, certain vacations that you hope to go on. Now, while this document is available in our office, we can certainly follow it up if you want to put a note that you'd like one in our Q&A. Kendall can certainly send that to you after the webinar today. One of the tools we also use in our office, some of us use the free version, some of us use the $8 a month version, is an application called Every Dollar. It's produced by Dave Ramsey, which you might be very familiar with that. In fact, I know a couple of you are very familiar with Dave Ramsey who are on today. But it's a great application that does exactly what I'm showing you here, but it does it online. It allows you to use your phone in the application to drag and drop certain expenses that you may have, or type them in and put them in categories. So specifically, the dining out category, if you had a budget of $100 for a month and you went to Chick-fil-A or you went to a fancier restaurant than that, and it cost you $27, you could type that in and drag it into the dining out category. Or the paid version, it comes up automatically and you simply drag and drop it into that dining out tab. Building block number 2, assets and liabilities, or your net worth. What you have, your assets, and what you owe, your liabilities, makes up your net worth. An understanding of these things allows an advisor to make appropriate recommendations based on your situation. So this becomes a home base for us to determine what savings rate might be a good recommendation for you, at what rate you pay off your debt, at what income we might suggest you consider in retirement, and how you're going to address financially the goals you have in retirement, like travel or a kitchen remodel. Here's an example of our retirement planning tool. I have an example couple here, Joe and Judy Blocks, and their net worth statement. As on the screen, you can see their checking account has $8,000. They have an emergency fund in their savings account at the bank of $18,000. Joe has a 401k. He has a traditional IRA. Judy's company offers a simple IRA, and their primary residence is worth $267,000. Of which, at the bottom of the page, you'll see that their primary mortgage, the remaining balance on that, is $40,000 until it's paid off. Building block number 3, savings rate and cash flow. It'll be no surprise when I tell you that the rate at which you save may determine how early you can retire. Many save for retirement, though, without understanding how much income they can generate from that projected savings when they do retire. This is another thing that we see quite often, that folks a lot of times pour their time and energy into careers, and they save and save and save, but they may not have ever done a plan and done the math behind where that is actually going to lead them one day. Now, to make matters worse, obviously we have volatility in the market, and that can confuse things, which our retirement planning software does address that. And I'll talk about that here in just a moment. But a retirement plan can calculate and project your anticipated savings based on your savings rate, as well as estimates of growth and volatility in the type of portfolio that you use. So building block number 3, savings rate and cash flow. On this page, you'll see the savings rate for the same couple, Joe and Judy Blocks, we've modeled here. Joe has a 401k, like we mentioned, and he puts in 4% of his salary, as you can see on the right side of the screen. His employer contributes or matches 100% of that 4% that Joe puts into his 401k. Some of you may have the same exact situation. A 4% match is very common for a 401k. His wife, Judy, has a simple IRA, as you may remember, and she contributes 3%. The max match an employer can do in a simple IRA for their employees is 3%. And so we've modeled that here under employer contributions. So where this puts us, I know there's a lot of information here, but what I'd like you to look at specifically is the retirement assets that this couple accumulates through the years. You will see on the far right side specifically that at retirement, they start decumulating or withdrawing money from the account. Retirement is specifically noted by that gray line on your screen. And then you will see a transition after about 3 or 4 years when they start to turn on their Social Security, that they stop withdrawing as much from their IRAs. So this is cash flow and how we map it out for our clients in their retirement plan. Building block number 4, your income plan and your risk tolerance. Are you willing to take on some risk if it might mean the reward will be greater? Or would you rather forego any anxiety in the market? An interesting thing happens, or at least I've observed, and I might speak absolutely here, and I realize it doesn't apply to everyone, but as I've noticed as I age and as the folks that we work with age, anxiety with market volatility seems to increase. And so as a general rule of thumb, most folks, as you get older and near retirement, begin to decrease how much risk they take in the market. Years for growth have minimized. That was then. Now, one of our biggest goals is to protect assets and turn the corner to use them for income. Your risk tolerance will be one item considered when an investment recommendation is made. Any good financial advisor will do this for you. Our philosophy is to take the least amount of risk necessary in order to accomplish your financial goals. So your income plan begins with how much is recommended for your annual spending. So back to block number 1, this is how it all ties together. Those few months of spending and analyzing what your guardrails need to be, coupled with our math around what your investments, Social Security, pensions, annuities may provide for you for a lifetime, come up with a recommended annual spending rate that we provide to our clients in their retirement plan. Your income plan with the combined work of your advisor and tax professional will also determine what accounts you rely on money from and at what point. Specifically, some of you may have Roth IRAs, you may have traditional IRAs, and you may have accounts that we call non-qualified or non-IRAs. All of those are taxed differently. And so depending on your tax rate, we might determine to pull a certain portion out of your Roth, your traditional, and your non-qualified account in order to keep you in a certain tax bracket. This is a layer over and above retirement planning where tax planning becomes incredibly important. It's one of the drivers as to why Link Wealth Strategies works directly with CPAs and great enrolled agents. I realize this is a pretty complicated page that you see here, but you'll see the title in the top left of your screen. This is a 5-year cash flow for Joe and Judy Blocks. Specifically, what I want you to notice is that Joe's salary and Judy's salary in 2023, their last working year. 2024 is the first year that they are fully retired. What we do in our retirement plans is we project out cash flow, and then in 2027, if you'll go out that far, you will begin to see the implementation of Social Security. At the very bottom on the far right, you'll see $19,165. That is the first year of one of the couple's Social Security. And it helps to decrease how much is needed to be withdrawn from the couple's investment accounts. So this obviously provides for longevity as Social Security, pensions, annuities decrease how much you need to take from your investment accounts. This cash flow report allows us as advisors to recommend certain courses of action to make your money last the longest. So we went through those 5 blocks very quickly. I want to stop, or 4 blocks very quickly. Before we get to the 5th block, I'd like to just remind you, if you do have any questions, you can submit them in the Q&A at the bottom of your screen. And you can certainly email us at any time at letstalk@linkwealthstrategies.com. So the 5th building block, the culmination of it all, the goals that you had intended for this next season of your life. The final basic building block of a retirement plan is the culmination or the goals that you have waited for this season. When do you want to retire? How much do you need to live on in retirement? What are your goals? Do you want to travel, take the family on a vacation, set aside money for your grandchildren's college education? What is most important to you? In our retirement plan for Joe and Judy Blocks, you'll see here we've modeled a retirement age for them at 66 and 62 respectively. We've also modeled that they would earn an estimated income of $60,000, $5,000 a month after taxes. They also would like to begin saving some money, not paying for it all, but saving some money for their grandson, Joey. And they'd like to do $2,000 a year until from now, 2023, for 10 years. Probably pay for some books, maybe a little bit of living expenses during college when Joey goes off to college. Judy would like to remodel her kitchen when she retires. She thinks it'll take 2 years to complete that project, and $10,000 is needed from her retirement to do so. Travel is something that's very important to this couple, and over and above the $60,000 a year of income that we're projecting, they would like to budget an additional $5,000 after taxes for them to travel. And then finally, they would like to spend a majority of what they have earned. However, they do have a small goal to leave $50,000 to their heirs. We base our retirement projections and our recommendations on what are called Monte Carlo simulations. This is a means of statistical analysis on what is possible for the couple's situation. What you're seeing here is the culmination of those Monte Carlo simulations where all of the financial variables and our math projecting out income for 30 years in their retirement with an addition for inflation through the years has been modeled 1,000 different times. What you see here, the model has shown volatility in the market as well. Best of years and worst of years in the portfolio that we've recommended for the couple. And based on all of those pieces of information, the Monte Carlo simulations communicate that this couple has a 97% probability of accomplishing all of the financial goals that I laid out to you on the previous screen. Now, what's good about this, while it's a great stepping off point in helping us to recommend investments for the couple and what's possible in their situation, it also serves as a home base when life gets challenging. As an example, last year, with such large inflation and dips in the market, upwards of 19% at the end of the year in the S&P 500, you can imagine that a lot of the folks that we work with get extremely anxious about that, especially as they're nearing retirement. This page becomes a frame of reference. All investments that we recommend and oversee for our clients is directly tied daily to this page that you see here. So it is possible that in a down market, this percentage could drop to 95 or 93. We use it as a frame of reference, a gauge on the dashboard of your car, if you will, that gives us an idea of knowing when we need to have a heart-to-heart conversation about an adjustment in your plan because of market returns or other financial circumstances. What I've seen it do is take people's eyes off of all of the noise and focus specifically on their situation and what they need to do to navigate the unexpected circumstances. This right here is what provides peace for our clients the most, in my opinion. We see it as the hub of the wheel. It's the center point of all that we are beginning to do and have done for a long time now with all of our clients. And then our recommended investments are the spokes on the wheel that contribute to accomplishing these financial goals. So the 5 basic building blocks for retirement, again, all words that you've heard before. What is your budget? What are the guardrails of your spending habits that need to be taken into account as you enter into retirement? What are your assets and liabilities? What is your net worth? What is the foundation of your financial situation that we will be making recommendations upon? What's your current savings rate? And what's your cash flow? And then your income plan in retirement. At what age will you turn on Social Security? If you have a pension, at what age will you turn that on? Does it make sense for you to use a portion of your investment to produce an annuity to get guaranteed income out of that vehicle for both you and your spouse? And what is your risk tolerance? How much risk are you comfortable with taking in retirement with your investment portfolio? And all this leads to the 5th building block, the culmination, the goals. What we weave all these pieces together for is to produce income and allow you to accomplish what goals you may have financially for the rest of your life. So where do we go from here? And I'll cover this, Kendall. If you would like to talk further about your particular situation, and would like to make an appointment with us, you can definitely do that by emailing or calling into the office to talk through these pieces. Furthermore, those basics are what we will ask of you in order to evaluate, tweak, or develop a plan for you. And that is exactly what we can do, is develop that hub of the wheel and make recommendations accordingly. So I realize I went a little out of order, Kendall, but please, if there's any questions, we can address them now.
Hey, no problem. Yep. First, really great question here. I had always been told our generation shouldn't count on Social Security. However, I haven't heard anything about it disappearing soon. Does this old saying hold any weight or truth today in 2023? Says Kyle and I are the same age.
You know, we hear it a lot as well, as you can imagine. What I've noticed with Social Security, I first of all do not think it's going anywhere. If it goes anywhere, I do think we've probably got bigger issues as a country. Now, that's my personal opinion. The reason why I think that is because it is such a stable, a bulwark of our society that so many generations for years have saved into this system and rely on it. Now, that doesn't mean that it won't be adjusted as the years go by. So the original retirement date in Social Security was 65. As as years have progressed, you can see that they have increased the full retirement age for folks as they age. I would not be surprised if that continues forward for folks in our age, in our late 40s. Whether our full retirement age remains at 67 or is raised to 68, 69. My personal opinion is that Kendall and we've got another gentleman, Creighton, that I mentioned earlier in the office. I would imagine their full retirement age is certainly going to be 69 or 70. I think legislative changes will occur in order to increase the viability of Social Security for generations to come. That's my personal opinion. I don't think it's going anywhere.
Thanks, Kyle. Another question, I think we have time for maybe one or two more here. How should I manage debt payoff versus savings as I'm getting closer to retirement?
That's an excellent question. So this is something that Kendall and I address quite often with folks as they near retirement. That angst, wondering if you have enough, certainly begins to surface. And quite often we'll get a phone call or sit with somebody that asks how much they need to increase their savings for the last 2 or 3 years of their career. In an analysis of their net worth, if we do notice, similar to Joe and Judy Blocks, that they have a mortgage of $40,000 remaining, our perspective and approach to that has to encourage them not to save anymore. Instead, we think the biggest bang for their buck is to eliminate that $1,000 a month mortgage, so to speak. So if we can encourage Joe and Judy Blocks to increase their payment towards their mortgage and eliminate $40,000 liability payment to the bank, they immediately have increased their cash flow by $12,000 a year. Now, granted, they still have home insurance and property taxes that they need to budget for, but they have eliminated the mortgage payment that they owe the bank every year. Mathematically, for us, that is equivalent to about a $200,000 to $220,000 investment account to generate $12,000 a year. That's why to pay off a $40,000 mortgage, still using Joe and Judy Blocks as the example, in the 3 years remaining in their career is much more powerful than trying to accumulate an additional $200,000 or $220,000 in investments.
Awesome. Thanks, Kyle. I think that's all the questions. I think that should be it. So I think we're good to go.
Great. Well, Kendall, I'll drop off and I'll let you close this up here.
Okay, absolutely. Yeah. So thanks for joining us today. We really appreciate you hopping on with us. So like Kyle had mentioned, if you're interested in learning more about your particular situation, feel free to reach out to us. Let's talk at linkwealthstrategies.com. We'll gather your basic information and start to make a plan for you. So if you're interested in joining us for further topics, our next topic coming up here in April is 1031 exchanges, having to do with real estate, how to kind of push off some tax liability with those in the future. So we're also looking at estate planning on May 3rd, and then college planning on June 7th. So feel free to hop back on first Wednesdays at noon through the remainder of the year. Thanks for joining us today.